A carbon tax is a tax levied on the carbon emissions required to produce goods and services. Carbon taxes are intended to make visible the hidden social costs of carbon emissions, which are otherwise felt only in indirect ways like more severe weather events. In this way, they are designed to reduce carbon dioxide emissions by increasing prices. This both decreases demand for such goods and services and incentivizes efforts to make them less carbon intensive. In its simplest form, a carbon tax covers only CO2 emissions. However, they can also cover other greenhouse gases, such as methane or nitrous oxide, by calculating their global warming potential relative to CO2. When a hydrocarbon fuel such as coal, petroleum, or natural gas is burnt, its carbon is converted to CO2 and other carbon compounds, allotropes. Greenhouse gases cause global warming, which damages the environment and human health. This negative externality can be reduced by taxing carbon content at any point in the product cycle. Carbon taxes are thus a type of Pigovian tax. Research shows that carbon taxes effectively reduce emissions. Many economists argue that carbon taxes are the most efficient way to curb climate change. 77 countries and over 100 cities have committed to achieving net zero emissions by 2050. As of 2019, carbon taxes have been implemented or scheduled for implementation in 25 countries, while 46 countries put some form of price on carbon, either through carbon taxes or emissions trading schemes. On their own, carbon taxes are usually regressive, since lower-income households tend to spend a greater proportion of their income on emissions-heavy goods and services like transportation than higher-income households. To make them more progressive, policymakers usually try to redistribute the revenue generated from carbon taxes to low-income groups by lowering income taxes or offering rebates. Carbon dioxide is one of several heat-trapping greenhouse gases emitted as a result of human activities. The scientific consensus is that human-induced greenhouse gas emissions are the primary cause of global warming, and that carbon dioxide is the most important of the anthropogenic greenhouse gases. Worldwide, 27 billion tons of carbon dioxide are produced by human activity annually. The physical effect of CO2 in the atmosphere can be measured as a change in the Earth atmosphere system's energy balance, the radiative forcing of CO2. David Gordon Wilson first proposed a carbon tax in 1973. A series of treaties and other agreements have focused attention on climate change. In the 2015 Paris Agreement, countries committed to reducing their greenhouse gas emissions over the ensuing decades. Different greenhouse gases have different physical properties. The global warming potential is an internationally accepted scale of equivalence for other greenhouse gases in units of tons of carbon dioxide equivalent. Economists like to argue about climate change as much as anything else. But on the biggest issue of all, they nod in agreement. Whatever their political persuasion, the best way to tackle climate change, they insist, is through a global carbon tax. A carbon tax is a form of pollution tax. Unlike classic command and control regulations, which explicitly limit or prohibit emissions by each individual polluter, a carbon tax aims to allow market forces to determine the most efficient way to reduce pollution. A carbon tax is an indirect tax, a tax on a transaction, as opposed to a direct tax, which taxes income. Carbon taxes are price instruments since they set a price rather than an emission limit. In addition to creating incentives for energy conservation, a carbon tax puts renewable energy such as wind, solar and geothermal on a more competitive footing. In economic theory, pollution is considered a negative externality, a negative effect on a third party not directly involved in a transaction, and is a type of market failure. To confront the issue, economist Arthur Pigou proposed taxing the goods that were the source of the externality so as to accurately reflect the cost of the goods to society, thereby internalizing the production costs. A tax on a negative externality is called a Pigovian tax, which should equal the cost within Pigou's framework. The changes involved are marginal, and the size of the externality is assumed to be small enough not to distort the economy. Climate change is claimed to result in catastrophe changes. Quote, Non-marginal means that the impact could significantly reduce the growth rate in income and welfare. The amount of resources that should be devoted to climate change mitigation is controversial. Policies designed to reduce carbon emissions could have a non-marginal impact, but are asserted to not be catastrophic. Two common economic alternatives to carbon taxes are tradable permits, credits and subsidies. Carbon leakage happens when the regulation of emissions in one country, sector pushes those